Hello, everyone. A very warm welcome to those that have joined Convera's webinar today already. But we are expecting quite a few more attendees from several countries today. So we'll just give it a little longer for more people to join. And in the meantime, I'll run through some housekeeping before we kick things off. So to start with, your lines are muted and your cameras are turned off. If you've got any questions, you can submit them via the control panel. But to answer a common question we're asked, yes, the webinar is being recorded and you'll be emailed the recording once it's finished. Also, you should see a resources tab on the control panel, and there you'll find a tab with links on it, and within that you'll find some links to our research, including what we're presenting today, which is our annual report called Are You Ready for 2025, as you can see on the screen there. Now, in terms of the speakers, we've got myself. I'm George Vesey, the lead FX strategist based in the UK. I'll be facilitating today's webinar and going over some FX outlooks towards the end of the presentation. And we've got Boris Kovacevic, our global macro strategist based in Vienna, Austria, and he'll be talking us through the key global themes within the report. So just in terms of the agenda, quickly, it's pretty simple. We'll delve into the key global themes that we think are most important to keep an eye on going into to 2025 and their impact on FX volatility and international trade. This section is going to be led by Boris, as I mentioned, and then I'll cover off the FX outlook, looking at some of the major currency pairs like the euro, the pound, and the Canadian dollar versus the US dollar. And we'll try and save about 5 to 10 minutes for Q&A at the end. So remember to use the control panel to post any questions you have. So from here, I think before we kick off into the global main themes, I just wanted to do a slight set the scene, really, a little introduction, because the details of this annual report that we're presenting today, they're exploring the key trends and the risks and opportunities for businesses as we enter what could be perhaps a stabilizing year, or potentially the calm before another storm. You know, after a whirlwind of disruption in the early 2020s, ranging from the global pandemic, the war in Ukraine, spiraling inflation that we've seen, aggressive interest rate hikes, the world economy did appear to be catching its breath. But now that Donald Trump has been elected as the next US president, 2025 certainly brings with it some more uncertainty and some pivotal questions, like could 2025 actually be a year of rebalancing or a year of renewed volatility? And should businesses be spending more time looking at de-risking supply chains ahead of any escalating global trade wars? Perhaps the question is more related to FX. You know, is the US dollar's ongoing strength going to start to wane, or will it accelerate under the assumption of global tariffs and a rebound in inflation, forcing the Federal Reserve to keep interest rates higher for longer? So there's plenty of uncertainties that exist, and this is likely why we are seeing this disconnect between economic data and economic sentiment at the moment, because although economic data has been surprising more positively this year, and there's evidence on the chart with the so-called misery index, which combines inflation and unemployment, that showed a sharp improvement in conditions over the last 12 months. So despite this happening, we're in this environment where consumer and business confidence numbers remain well below historical averages. So hence we're in this kind of vibe session situation, which is a neologism referring to the general public holding a more pessimistic view of its economy in the future. So why is this, and what are the key themes that we're watching out for going into next year? Boris, I'll hand over to you now to walk us through the global macro theme section.
Well, thank you very much, George, for so nicely setting the scene for us before we deep dive into the global themes and effects section, as you said. And of course, a warm welcome to everyone joining our webinar as well from my side. So I will be responsible for guiding you through the next 25 minutes or so. And my primary goal, I would say, is to explore how the world economy has really changed over the past few years, but especially 2024, and what our expectations are going into next year. And I think for me, it's also really important to highlight how much more complex the global macro landscape has become since the pandemic. So despite equity benchmarks and the world economy being at record highs, planning uncertainty still persists for not only investors and businesses, but also the central banks around the world. And we will explore this concept of uncertainty through these three themes that we have laid out. So the first one is growth. The second one is inflation and monetary policy. And then lastly, trade and geopolitics. And I think these three will nicely lead us into what is our FX scenario-based guide for 2025. So turning to this page, our first page on the growth outlook, it's always important for us to begin with the good news first. So the world economy, when we skip to the first chart of the slide, both the world economy and global trade volumes have never been this high. It did take a while for trade to find its footing following the pandemic shock, as you can see here, and it remains volatile due to various reasons that we will cover later on. But as I said, both the global economy and world trade are around 15% higher now than they were 5 years ago. Of course, looking at this aggregate data from a global perspective does not really tell us the whole picture, which is much more complex and nuanced. Namely, if we turn to the second chart, that China and the US have mostly been responsible for this resilience of the global economy. Despite high inflation, despite high interest rates, still the global economy has been up 15%. And if you look at China and the US specifically here on real GDP growth since 2019, both economies have risen by 26 and 14% since COVID, while Europe, on the bottom of the chart, they pretty much stagnated throughout the last 5 years. And on the next chart, we can kind of start to dive deeper into explaining why the US and the Chinese economy have been in such an exceptional place to begin with. So looking at the US economy and focusing here on the chart on the right-hand side, just look at incomes, look at GDP, but also retail sales. They're all up 34, 35% since 2020. Imports are up 37%. Goods spending is up 40%. But most importantly, if we focus on the left-hand side of the chart, US government debt is up 55%. Now, the US government took on massive amounts of debt to stimulate its economy over the past few years. And it really seems to have paid off in the short term for US consumers, but also US companies. Because on the next chart, we can actually see that this productivity gap between the US and the rest of the world that really started opening up, I would say, at the beginning of the 21st century, has started widening again since 2020. So a fascinating insight for us on this chart is that with every single crisis we have had, be it the 2001 dot-com bubble, be it the global financial crisis in 08, 09, or the latest one, the pandemic shock, the US economy came out stronger out of the crisis than it began with, which is not the case for the other countries. So looking here at real GDP, real productivity growth, in the US, it's up 15% since the pandemic, while it's flat on average for the UK, Germany, and Japan. And this extends well beyond productivity growth as well. If we look at business applications, for example, in the US last year, we had 5.5 million new business applications being filed in 2023. And this came with AI investments continuing to make new highs. So in my opinion, this theme or this story has been one of the main drivers of the post-pandemic era that continued to dominate the narrative in 2024, which is this exceptional position that the US has found itself in over the last couple of years. So switching to the next chart, I think the other side of the story is, of course, China, which is the second largest economy in the world. Because as with the US, China continued to stimulate its economy from, in particular, a monetary policy perspective, and to a lesser degree from a fiscal perspective. So interest rates in China, contrasting to what we have done in the West, are at record lows. Financial conditions are as easy as they have ever been in China. And while this hasn't really helped the Chinese currency or its stock markets outperform due to this ongoing property crisis that, in our opinion, will take some time to unfold as well. But it did continue to push China's manufacturing dominance to new heights during the last couple of years. So what we can see in this chart really drastically is that China now manufactures more output than the next 9 largest nations combined. So China makes up around 35% of global manufacturing production. And this also extends, of course, to its exports. So if we switch one chart to the right, What we can see here is the composition of how much exports have changed since the pandemic. And on the left-hand side, we can see China. Chinese exports are up around 35% since 2020, while on the right-hand side, European volumes have fallen by 5%. So Europe has actually lost a small proportion of its trading share since 2020. And this again highlights that while looking at the aggregate data is important to set the scene, to set the context, it still masks these regional divergences that have been playing out all throughout the first decade of the 2020s. So, one narrative I think that is important to highlight on the next chart that has been pretty consistent across countries where we didn't really see these regional divergences has been the tightness of labor markets. So in this chart, for example, we look at unemployment rates in advanced economies. And for the first time in 40 years, the unemployment rate fell below 4% last year. So the bottlenecks, the worker shortages that we had in 2020 and 2021 have led companies to basically hoard workers and to lead to some kind of a reluctance to let go of these employees. And this has led to a really tight labor market that, of course, the consumers and the workers have profited from. So this is one, I would say, broad cross-country theme that also explains the resilience of the world economy and world trade. And our assumption, just to go a bit beyond the status quo and look at 2025, our assumption is that the unemployment rate will rise marginally on a global level, but remain well below historic levels. And this should, in theory, act as a tailwind against all the policy uncertainty that I've been mentioning as tail risks. But the risk, again, is here that if we do get weaker growth next year because of the tariffs the US is likely to impose on the rest of the world, we do get more layoffs and, of course, a rise in unemployment. So I think this would be the first risk that I mentioned going into next year. On the next chart, as it relates to the unemployment rate and wage growth, we do expect that real wage growth should be supportive of the continued recovery of the consumer. So in this chart, we can see the global consumer confidence and the sharp increase we have seen since around the middle of 2023. And this is one reason why we actually expect global growth expanding by around 3% next year for a third consecutive year in a row. And we can see kind of the composition of global growth in the next chart, where we look at the drivers of global growth from a regional perspective. And clearly, you can see on the left-hand side, China and the US will likely continue to lead the pack in terms of global growth outperformance. But a cyclical recovery in Europe is still in the cards, I think, for next year. And it is important to stress that this is our base case. But I intentionally did take some time at the beginning and throughout the presentation of this first theme to highlight that, again, the macro environment post-pandemic has really become more complex to navigate through. And two of the biggest risks I would say we see heading into 2025 are that inflation remains anchored on higher than expected levels, which in a sense would lead central banks to keep interest rates higher than they usually have to. And second, that the trade war between the US and China, but also between the US and Europe and China, dampens growth expectations and pushes inflation even higher, right? So these are the two big risks. And we can look at inflation first and then move to trade to see how likely they are to develop. So on the next slide, turning from growth to inflation monetary policy, just a quick reminder before we switch on to the first chart. Inflation has really been the most polarizing economic development that has come out of the pandemic era and these government stimulus measures. It is, in my opinion, the main reason why President-elect Donald Trump secured a second term, according to both polls, but economic models as well. But I think the fascinating insight here is that it extends well beyond the US. So 2024 will most likely go into the history books as the first year on record in which every single governing party has lost power or popularity in an election. So not only in the US that we have already covered, but even in the UK where we had the shift in the ruling party. In Germany, in the upcoming elections, we had Austria, we have France, we had the Indian election. All the governing parties lost share in their party seats. And global inflation, if we now switch to the first chart, I think global inflation hitting 40-year highs in 2022 is really to blame for this recent development. And I think the good news, as you can see in this chart, is that inflation has fallen drastically from around 9% at its peak in around the end of 2022 to sub 3% right now, which is the lowest level since early 2021. And one consequence of this disinflation has been that central banks were more confident to stop raising interest rates and actually start cutting interest rates. And this was, I think, one development we have seen over the last couple of weeks. So the Fed in the US, the Bank of England, in the UK, the European central banks, they've all lowered interest rates this year and are expected to cut or ease policy next year as well. But it is still important, I think, to not become complacent in regards to inflation risks, because on the next chart, we can actually see that interest rates on the long end of the curve, displayed by the 10-year bond yields, they're still hovering near 16-year highs. And if we do expect an uptick in inflation next year, this could mean that these interest rates will be anchored at higher levels than historically, or at least higher levels than the average of the last couple of years. And this could potentially be a second tailwind for global growth and consumers and businesses that are slowly but surely trying or needing to refinance even existing investment projects, but also mortgages on the consumer side. So it's not like these small rate cuts that we have seen from the Bank of England or for the Fed, that these have significantly eased the pressure on the consumer. So we do expect them to cut interest rates a bit more. But again, we would need to see, first of all, inflation come down so that central banks have the willingness to cut interest rates. One problem to this scenario on the next chart is that we've really seen a slowdown in the progress of inflation coming down recently. So core inflation have basically stagnated around 50 basis points above the target of the central banks, which is around 2%. So in the UK, for example, how to read this chart is in the UK, core inflation is still around 1.2% higher than it should be according to the Bank of England's mandate of 2%. And markets and central banks are becoming worried that this will become the new norm. If on the next chart, for example, we see that the share of countries globally in different inflation regimes. So before the pandemic, around 22% of countries experienced inflation between 2 and 4%. Now that share is up to 36%. And I think this is what economists generally phrase as the last mile is the hardest, meaning that bringing inflation down from, let's say, 8 to 4% is in theory easier due to base effects falling off than bringing inflation from 3 to 2%. And our expectation does kind of fit this mantra because we do see inflation being well above 2% in Canada, in the UK, in the US, well into 2025. On the next chart, I think this is what we can see in terms of the inflation forecasts. The Eurozone is a bit of an outlier in this forecast scenario because in the Eurozone, we have, first of all, sluggish growth expectations for next year. We have a partial government crisis in Germany. And this is, I think, what could likely keep inflation anchored below the target. So this is our base case. But I would even say that markets in recent time, at least, have started agreeing with that assessment. Because if we switch on to the next slide, we can see the market pricing for the options market for the policy rates in the US, in the UK, and in the Eurozone, extending to 2025, but also beyond that. And what you can clearly see is how much more policy easing is being priced for the ECB versus its peers in the US and in the UK. And again, I think this partially is explained by the poor performance of its economy. And as George will likely mention, this is also an explanatory factor of why the euro has underperformed against both the pound, but also against the euro. So I think in summary, to finish this slide off, inflation has cost a lot of governments the election this year, but there was a lot of good progress done on bringing price growth down. And now I think this has allowed central banks to start easing policy. However, the easing cycle has been much more slowly progressing as we would have expected, given the stickiness of core inflation and, again, the prospects of an inflation uptick maybe next year due to the tariff war being kind of starting at the beginning of next year with Trump's presidency beginning. And this already, I think, brings us to the last macro theme of the year, trade and geopolitics. And as I said, when we switch to the first slide, the volume of goods and services traded globally is still near an all-time high. I think this is really important to recognize as a good development, even despite the pandemic, even despite having the wars in the Middle East and the wars in Europe going on. But the trend of national policies being implemented that benefit the domestic producer base has really been clear, and globalization factors have started peaking after the global financial crisis. I think 2 points to make, just to go from the macro to the micro perspective to what is relevant for companies right now. I think first, the kind of the first insight we had is that the sole purpose of maximizing profits as a company that has really dominated company thinking over the last couple of decades has, in my opinion, given way to companies making more politically akin decisions. So friendshoring has been prominently featured in both earning calls in Europe and North America. Because of the US-China trade war, for example, because of the Russian invasion of Ukraine and the Chinese-Taiwan spat, making these geopolitical alignments a key concern. And the second point that we mentioned in the report is that we have these rising geopolitical tensions, and they have clearly impacted the perception of consumers and companies towards the quote unquote other side negatively. So Chinese consumers, for example, looking at surveys there, they continue to display this slight trend, this slow but still clearly visible trend of switching from foreign goods to domestic goods. And even in Europe, according to a recent ECB survey, 60% of European companies see China as a potential risk to their sector supply chains. And all of this does mean that this globalization that we have seen over the past couple of years will likely continue into the second half of the 2020s. So the calm waters on the next slide, the calm geopolitical waters, how we mentioned them, in which international companies have really been able to maneuver carelessly in the 21st century, or most of it, is starting to get more volatile. And one reason we mention for it is that politics is starting to insert itself again into economic life and in economic policy. So on this chart, for example, we can see that the number of annual trade interventions implemented each year globally has risen tenfold since the 2010s. So in the 2010s, we had around 500 policies implemented on a trade basis every single year. Now we have around 2,000 industrial policies that are being implemented every single year since the 2021 year. And most of them are highly trade distorting, and they are heavily centered around these three big regions, which are North America, Europe, and East Asia. China has, of course, been one of the biggest culprits of this practice of subsidizing its industry over the last couple of years. But I think the key insight again here is that it does go beyond China. So on the next chart, we can see that both President Trump, that started this trend in 2016, but also President Biden, have pushed industrial policy back to the top of the policymakers' agenda in the US. So manufacturing, construction spending, for example, on this chart, has really risen exponentially in the last 2 years. And this is an active consequence of active policymaking. So this is explained by first the Inflation Reduction Act in the US, which interestingly, looking at surveys, has really received negative comments from companies in Europe. And second of all, the CHIPS Act in the US. And this has led to a surge in manufacturing construction of new factories that are supporting this new transition of being independent in terms of chip making. Europe had, of course, its own CHIPS Act that tried to emulate the successes of the US, and China, as I said, continues to subsidize its high-tech industries as well. And on the next chart, we can actually see, if we focus and go away from the US to focusing more on China, we can see how much industrial inventories in China have outgrown industrial production. And this is something that really points to China trying to crowd out other countries in international markets. So producing more than would be necessary given the demand, with prices often below the production costs. And this is, I think, one reason that also explains the recent rise in trade disputes between China and Europe, which of course manifested itself lately in Europe imposing tariffs on electric vehicles on China, and China, of course, retaliating with its own measures. And I think these developments overall will shape decision-making of companies working internationally over the next years, especially as President-elect Donald Trump has already proposed or promised a continuation of the trade war that he started in 2018. China has been or tried to make good progress in decoupling itself from the dependence it had in the US at the beginning of the century. If you look at the next chart here, for example, we can clearly see that Chinese exports going to North America, which is the black line, has fallen from 23% at its peak around the beginning or early stages of the global financial crisis to now being around 16%. While the importance of smaller regions for China, like Latin America, like Africa, this share of exports has basically tripled in the last 25 years, from around 6% to 15% right now. So China is more or equally dependent on North America as it is on these three smaller regions. And this development, again, will likely continue over the next couple of years under Trump, because as Trump imposes tariffs, as China retaliates, this will see trade between those two regions fall. It shouldn't have too much of a drastic impact on our GDP outlook, given that both consumers and producers will likely shift their preferences to avoid these tariffs. But still, in terms of inflation outlook, in terms of bipartisan trade between those countries, it will definitely have an impact on both China and the US. On the next slide, I think an important key issue that I haven't talked too much about is, going from the US and China as these two biggest regions, but also talking about Europe. One country that has been on the less fortunate side, I would say, of all these structural shifts is Germany and the Eurozone overall. And I think Europe's largest economy here is, I think, the perfect example of why these global multi-year trends are still important to keep track of in an annual report like ours. Because Germany was hit both by the US and China shifting to a more regional industrial policy, but also by the Russian invasion of Ukraine, which in the end led to higher energy prices and to industrial production in Germany now being 25% below its pre-pandemic trend. And I think most people, especially outside of Europe, don't think about the war in the Ukraine anymore or too often, but it is still going on. It's still leading Europe to try to diversify and decouple itself from energy exports, energy imports from Russia. And this is, I think, something of a legacy that won't go away even in the years to come. And even if we get a ceasefire under Trump, like he has promised, I think the energy decoupling from Russia away will, as I said, be a lasting legacy of the war that has changed diplomacy around the European continent. So again, Germany has lost its cheap energy from Russia. Diplomacy with China is becoming more nuanced and complex, which is why this uncertainty index for Germany is well beyond anything we have really seen in the developed market in the 21st century, as you can see in this chart. To add to kind of these worse matters is that the government is currently going for a crisis as well. There will be a vote of confidence in late December, which will likely lead to a snap election in February. But however the election turns out in the end, our view is that we will get a tilt towards more national and industrial policies, as we have seen in China and the US. So I think the broader point I'm trying to make here with these three themes, but especially with the later one, is that companies that we talk to, CEOs, CFOs, they really need to be aware of the changing geopolitical and trend landscape. And of course, these kind of big ticket items, these developments won't affect profit margins right away. But as I said, the world economy is doing just fine. Trade is well underway. Equities in most countries are in record highs, and so are company earnings. This is not about being pessimistic about growth next year, which we are definitely not. I mean, 3% real GDP growth for the world economy isn't great, but it's not too bad at all given historic averages. I think this is more about recognizing that companies need to put trade and geopolitics back into their medium-term planning, 3 to 10 years, for example. And it's about knowing that there are these tail risks beyond the baseline forecasts going into next year and 2026. So I think that's pretty much what I wanted to cover. I know it's a lot of information to take in, but we will have a Q&A section afterwards. And you can always reach out to us via email for any inquiries, for any questions that you might have. But for now, I think it's a good time to hand over to George to look at the recent developments on the currency markets. So back to you, George.
Yeah, thanks a lot, Boris. As usual, some incredible insights there, explaining the trends that we've seen since the pandemic, of course, and this year, and then, of course, what to keep an eye on going into next year and beyond, and giving businesses lots to think about and plan for, especially, as you said, in terms of geopolitical and trade developments. Now, my job is to try and cut through some of this noise and provide an outlook for exchange rates. And I think how all of this is impacting currencies can sometimes cause a lot of uncertainty, a lot of worries around the outlooks. And I think what really stood out to me in Boris's presentation, especially at the beginning, was the whole US exceptionalism narrative. And so before we move on to the actual outlook itself, I think it's important to reflect and just take a step back first. To this time last year when we had we did this webinar for Are You Ready for 2024? And we had a negative view on the US dollar for 2024, predicated on the assumption of a weakening US economy and the Fed cutting interest rates aggressively. And this was the consensus view as well. It was the market's view. As you can see on this chart, to the left-hand side of the charts, yields were falling last November when markets were pricing in around 6 Fed cuts this time last year for 2024. That led to a weakening of the US dollar. And then, of course, this view was obviously challenged quite early on this year by the cyclical narrative with a significant adjustment higher in US GDP growth and the associated less dovish Fed easing expectations unfolding. So less rate cuts being priced in, lifting yields, as you can see, and therefore helping the US dollar. But before the US election, as you can see on that third kind of section there on the chart, we did think that the dollar's reign was going to come to an end in 2025, purely on the basis of a slowing economy. Other economies started to catch up, a weakening US labor market that was starting to emerge. And of course, the Fed had started cutting interest rates with that jumbo 50 basis point cut. Yields were falling, the dollar was falling, as you can see, up until the end of September. However, that was a point when we did actually have a strong US jobs report, a couple of them. The disinflation trend started stalling, and Donald Trump was polling well in the US election. So we started to see yields rise again, as you can see, and the US dollar strengthening. And now we are in this situation where we have Donald Trump elected as the new president of the United States. So therefore, those trade tariffs and more fiscally stimulative policies seen to boost near-term economic outperformance of the US versus the other G10 countries means that this expected near-term a cyclical implication of a second Trump administration is quite a compellingly dollar positive case. So that's via the tariff and the fiscal and monetary policy mixed channels. And in fact, as the Trump leadership starts to take shape, the market is starting to take his threats more seriously. It seems, sensing that Trump may. It seems that early sense that Trump may be more pragmatic in power than he was on the campaign trail is actually being replaced by this more hawkish interpretation of his stance, and therefore that's seen as quite a dollar positive scenario across the board. But as per the chart on the right here, it stretches beyond the US election. This dollar positive view, investors are refocusing on the macro fundamentals as well, and there has been a rise in the short-term macro risks, as you can see on this chart here, and that does suggest that the path of least resistance for the dollar is to the upside over the next few months. But again, we did provide in our US election guide a caveat to that, in that we are wary of a US dollar reversal, given that under a Republican administration, the US dollar does tend to underperform over the whole course of the term. And given it lost 9% in the first 7 months of 2017 in the post-election reality check, we are wary that something similar could happen. But again, things are different this time around. And as it stands right now, that Trump trade has got a lot of momentum behind it. As for the euro, we have seen this shift in relative interest rate expectations. Sorry, I think we have lost the share screen. Bear with me 1 second. Sorry for the technical glitch. Bear with me 1 second to just get the screen back.
I can share it as well, George, if you want to.
Cool, got it.
Sounds
Apologies
good.
for that. PowerPoint died on me, but we're back in action. So as for the euro, because this is basically transpiring to a euro dollar forecast, guys. So I just wanted to touch on the euro first before going over to that forecast scenario slide. For the euro, we've seen this shift in relative interest rate expectations in favor of the US. And that's one of the transmission mechanisms of this Trump victory. Plus, assuming that Trump does these targeted and large-scale tariffs against Europe and China, like the 20% tariffs on all US imports, for example, economic theory does predict that the dollar should appreciate mid-single to low double digits to partially offset that shift in relative prices. So basically, the prospect of the looming tariffs at this already very weak stage in the economic cycle for Europe could revive those recession concerns, and that could add another compelling case for euro weakness, opening the path potentially for a break below 105 and towards parity potentially. And in the wake of the US election result, as we saw, the euro dollar exchange rate slumped almost 2% on the day. And that was his biggest daily drop since March 2020. So for me, that was a big warning signal really from the spot market around these risks of the trade tariffs for Europe. But even in the build up to the election, as you can see here, and as we pointed out on the slide before, rate differentials between the Eurozone and the US had tumbled from late September as more rate cuts as well were being priced in for the European Central Bank, as Boris mentioned earlier, compared to the Fed, and that was already dragging the euro lower. So there's certainly this feeling of deja vu as euro dollar views start to adjust to the downside on the prospect of these tariffs and also a more dovish ECB versus the Fed. And the next chart here just shows of when Trump was elected back in 2016 and euro dollar fell around another 4% through the end of the year. And if history does repeat, then we could be looking at below 103 for euro dollar. Now, back in 2017, we did obviously, as you can see a pretty strong recovery of euro dollar. But then the tariff announcement was made and the pair came tumbling back down around 5% over 2018. And as I mentioned before, I think this time round is different though. The world is a different place, as Boris has walked us through since the pandemic. Lots has changed. But what's also telling is the euro's dire reaction so far to Trump's win and the prospect of Trump hitting the ground running this time and his policies coming to fruition quicker than they did during his last term. And that's seen via his leadership team starting to take shape, as I mentioned. Now, if you've been watching our webinars before, then you'll know that at Convera we believe in taking a scenario-based approach when it comes to understanding where exchange rates could go, and I think it's more of a suitable way to understand the possible implications of various events unfolding. But as a team, as a research team, we do, of course, form opinions based on particular assumptions. And the previous two slides that I wanted to share is why that it is just showing that why now that we've had that US election is why this chart has to be updated really. Our baseline scenario has actually shifted lower for euro US dollar. We always saw it as a downside risk, so it doesn't mean that this forecast scenario chart is outdated. It just means that the balance of risk has tilted lower since Trump's win, i.e. that downside scenario is more likely to play out now, especially under a clean red sweep outcome. So whilst parity isn't our base case, we're not saying that, but the probability of euro trading at parity against the dollar over the next few months or into next year has increased significantly. But it's not just only due to Trump's victory, but as we mentioned on the domestic front for Europe, with the ECB expected to cut interest rates more, and as Boris mentioned, we've got the political turmoil in Germany due to the looming snap election. It's all adding to headwinds for the region's already fragile economic and political landscape. So the bottom line here is that there is a plethora of negative factors pushing the euro lower, as well as positive drivers of US dollar strength going into next year. And moving on to the pound next on the next slide. Again, as you can see, our base case here against the US dollar is actually for an extended recovery. And I wouldn't go so far as to say that we've downgraded it as we will have done for euro dollar. And again, this kind of scenario-based approach allows businesses to be aware of the upside and downside risks to the base case. And the downside risk is, of course, a more severe UK economic slowdown, a cooling jobs market, and I think that one of which that forces the Bank of England to cut interest rates more than markets are currently pricing in. Because if you think this year, the pound has actually been the best performing G10 currency for most of this year, and it still is, in fact. And this is largely due to the more hawkish Bank of England relative to its peers. And that's as a result of sticky services inflation. We've had strong wage growth. But the price for delaying these rate cuts is potentially a more aggressive cutting cycle when it eventually kicks in properly. And this is the risk for the pound, I think, going into 2025. Nevertheless, go on to the next slide here. The UK-US real yield spread is still favouring the pound to edge higher in the very near term, as you can see on this chart. And plus, sterling is classed as a pro-cyclical currency, as you can see on the chart on the right. It does remain in this positive uptrend phase since the start of this year, and that's again thanks to the global easing cycle getting underway, and that's a big boost for pro-cyclical currencies like the pound. And so we think this near-term positive sterling view was boosted by these factors, but also because of the political stability as well, with the Labour Party's win and hopes of a stronger trading ties with the EU. And plus the stimulative UK budget that we had just adds to this hawkish monetary policy story that the pound's been hanging on to for most of this year. So I think with all of this, taking all of this into account, I think it is in a better position than the euro at least. And therefore, in light of that, the last couple of slides, we do think that the risks are skewed to the upside for sterling against the euro. The UK is likely less exposed to direct tariff risks than the Eurozone is, given its trade deficit in goods with the US. And therefore, as a result, this arguably opens up a positive tailwind for the pound versus the euro. I mean, the UK is not going to be spared tariffs from the US, but the bottom line is that it's all relative when it comes to the impact on the currency, and UK GDP may be less affected by those import taxes than the euro area. And given that it's healthier cyclical dynamics and fiscal monetary policy mix are more positive for the pound than the euro area, then this is another reason why we think that the pound could continue climbing against the euro, creeping into the top end of that central scenario and maybe even into the lower realms of that upside scenario next year. I'm really highlighting the positive monetary policy dynamic is the real yield spread between the UK and Germany here that's overlaid on the left-hand side. It's been shifting higher since more ECB rate cuts have been priced in compared to the Bank of England, plus that German snap election adds another element of political instability, as I mentioned earlier, and this could continue weighing heavily on the euro like the French elections did earlier this year. So all in all, we are leaning more bearish, or rather more negatively towards the euro's outlook relative to both the US dollar and the British pound. But in terms of sterling euro, I thought I'd share the last chart here on this particular section, because sterling euro is already above that 120 mark, and that's the level we've only been above for 4% of the post-Brexit period, so the last 8 years or so. It's around 2-year highs. and around 5% higher than its 5-year average. So, all of this suggests that at the current levels, it should be really attractive for any companies that are selling pounds, buying euros on the spot market. But granted, as per the right-hand side chart here, the hedging costs to take advantage of this and lock in the exchange rate comes with a hefty penalty because of the forward points due to the interest rate differential. And that's only really going to change if markets start pricing in more Bank of England rate cuts. But again, this is probably going to result in a weaker pound on the spot market anyway. Now, the final part from me today is the US dollar against the Canadian dollar. This is the final currency pair. It's been the least volatile currency pair in the G10 complex so far this year, and also in the case of the aftermath of the US election, it was the least volatile. But still, the pair has risen towards 140, its highest level since early 2020, so over the past 4 years, highest level. And there's certainly some resistance around this kind of area now. And I think the CAD was really the outperformer during Trump's first presidency, and the broadly growth and yield-driven positive dollar context may actually benefit the Canadian economy, and therefore the Canadian dollar could outperform its G10 peers going into next year in line with the US dollar. But also, the virtues of the CAD's role as a dollar proxy might also appeal to those believing that the US economy is going to outperform, but they're concerned around the long-term structurally dollar negative implications of Trump's policies, especially when it comes to debt sustainability. And I think this is why our baseline scenario, as you can see there, trends higher to begin with before turning lower halfway through next year. And flipping over to the next slide, we still have this strong reason, or this strong catalyst for the loonie being so weak for this year, and that's those long dated yield spreads. They've been driven higher as a result of the dovish Bank of Canada compared to the Fed. So no big surprise to see why the CAD has underwhelmed recently. Plus, as seen on the right-hand side, as I mentioned, Canada's economy will be highly exposed to Trump's trade policies and would suffer from any rupture in those bilateral in the bilateral trade flows as well. So this is something to be wary of. It's definitely a big negative risk for the CAD, and therefore an upside risk to the US dollar CAD exchange rate. Hence, the potential renegotiation of the trade accord between the US, Mexico, and Canada, which I think that can be reviewed around July 2026. That's going to be crucial for this exchange rate going forward as well. But as ever, the main takeaway from all of these currency forecasts is that it's really imperative to consider a range of scenarios and make sure that as a business trading internationally, you are sufficiently positioned to take advantage of any favorable moves that do occur in the exchange rates, but also, of course, being sufficiently positioned to be or protected to some extent in the event of adverse currency moves unfolding as well, which we all know can happen. They have happened, and they can cause some serious disruption to your international trade. Now, I know we've been talking for quite some time now, so conscious we've got about 10 minutes left. So thanks for everyone for sticking with us so far. I appreciate there's been a lot of content to digest, but the presentation has finished from us. We've got some time for the Q&A, as I mentioned. So if you want to submit some questions via the control panel, please do so. And Boris and I will try answering as many as possible. Boris, you've had some time to review the ones we've had in so far, so I'll hand over to you to kick it off.
Awesome. Sounds good, George. So the first one that struck me was a question on the tariffs. It's how will tariffs impact global growth and inflation? And in your opinion, how likely is a 60% tariff on China? I think this question opens up a field of possible answers from my side and how to tackle it. First of all, there are a lot of ifs and buts when it comes to the incoming tariff war between the US and China. Because first of all, it's really hard to gauge how likely the 60% tariffs are to be imposed on China. In our opinion, Trump is using them as a kind of leverage to start negotiating with China in terms of them buying more, especially agricultural goods from the US and decreasing this high trade deficit that the US has with China. It isn't likely that there won't be any tariffs. So this gives us a possibility of 10 to 60% tariffs being imposed on China, with our base case being around 25 to 30%. And the US will likely impose the 10 to 25% tariff on the rest of the world, which opens up the question on how this will impact, of course, currency markets and the global economy. So when you model it, most economic models tend to agree that the impact on real GDP growth in the US will be limited, just due to, as I explained in the presentation, both consumers and producers, both in the US and outside, are flexible in terms of shifting their preferences and where they buy their goods from, at least in the non trade sensitive sectors of the economy. And this will likely lead to a dampened effect on real GDP. However, trades or bilateral trade will be heavily impacted. We will see a clear shift from US-China trade to both countries trying to compensate the lack of the trade between each other with different countries. And this could actually lead to some countries benefiting from the tariffs being imposed on China. So this is kind of the first part in terms of the impact on trade and GDP. The impact on inflation, I think, will be the most important one for markets and for the Fed, because we do tend to agree with the consensus models that it could shift inflation by around 0.5 to 1% for the whole of 2025 and 2026. And this doesn't sound too much at the beginning on the surface level, but going from 2% inflation to 3% inflation is really a big deal for central banks, especially for the Federal Reserve. And this alone will likely lead to less rate cuts from the Fed next year and in 2026, and to higher than expected and longer than expected high interest rates in the US, which could, of course, dampen risk sentiment in the long run. So it is, as I said, a really complicated question to answer. But as of now, the information we have is that GDP will not be impacted as much, but bilateral trade flows will, and inflation will most certainly lead to a change in interest rates to the negative side for markets.
Great, thanks, Boris. Another question has come in around Trump and the US dollar. What about Trump wanting a weaker dollar? He's been quite vocal about that. But also another, I'll do these two in one. There's another one relating to Trump's cabinet, the latest selection, and how and what that means for the US dollar. So firstly, with regard to the cabinet, as I mentioned in the presentation, I think there was some thoughts behind whether or not Trump was going to be more pragmatic when it comes to these policies and who he was going to instate. And I think, as we've seen, these the selections that he's made have been real hawks against China with trade. So all of these, I think, kind of signal that this whole Trump trade momentum, and as evidenced by the market reaction, is really gaining traction. And we could see these policies instated much quicker than what was first thought, and therefore, as a result, we could see the US dollar strengthen considerably in the near term as well. And I think, as per the market reaction, it just sheds some light into the thinking behind what we've witnessed already, behind what impacts the selection of Trump's cabinet will have. But ironically, Trump does actually want a weaker dollar, and all these policies are mostly dollar positive, despite the fact that he's expressed on a number of occasions that desire for a weaker currency. So it naturally generates questions around the scope for an intentional devaluation of the dollar. And I think there's several ways in which he could obviously go about trying to weaken the dollar. And one of them could be fiscal tightening, which has that direct implications for the dollar via slower economic growth, lower interest rates, less favorable capital flows. But this just goes against his fiscal easing program that he's promising. So it's highly unlikely. Could try and erode the Fed's independence. Obviously, this involves the central bank keeping monetary policy looser, and then required to keep inflation at target. And the net outcome of that would be lower real rates, higher inflation, and a weaker currency. But again, the reality is that the Fed Chair Powell's term doesn't end until 2026. So this is probably not going to be ruled out for at least a year. And there's really some uncertainty as to whether the president can actually remove a Fed governor from their position ahead of that. And plus, it wouldn't go down well with the public, I don't think either. Alternatively, maybe an option would be multilateral intervention, like a new Plaza Accord. But realistically, the dollar's much less overvalued now compared to the 1980s. And the reality is that the dollar is pretty fair valued given the strength of the US economy and where US interest rates are at the moment. So for now, I think the economic fundamentals mean that the dollar will remain stronger for longer against many peers. Any more comment? We've got Trudeau will be voted out next year. Will that strengthen the Canadian dollar? I think yes, politics does play a part in currency volatility, but I think the current landscape really bears more weight with Donald Trump and the trade policies. I think, as I mentioned in the US dollar CAD forecast chart, there one of the major things that's going to impact whether or not the Canadian dollar is going to strengthen or weaken next year is whether or not these universal tariffs extend over to Canada as well. But Boris, I don't know if you've got any thoughts on the Canadian politics over there.
Well, I mean, I think you perfectly summarized it. Politics is important when it comes to these global shifts that companies have to be aware of. But in terms of the Canadian dollar underperforming as of late, especially after COVID, it was mostly a function of the Canadian economy underperforming the US one in quite some drastic ways, not only in real terms when you look at GDP, GDP per capita, or even productivity gains, but also the Canadian central bank trying to mitigate these risks and lower interest rates much more aggressively than the US Federal Reserve has. And we are expecting this to continue, which of course is highlighted by the forecast that you shared with us, where we expect the uptrend, at least in the first part of the forecast, to continue. And one question has been, of course, if dollar CAD will start flirting with its 5-year high at 139. I don't know what your sorry, at 145. I don't know what your opinion is, but I think in the short term, this is still unlikely. We would need to see a much more of a continuation of US exceptionalism going into next year to see this play out. I think one scenario where we do see dollar CAD trend much higher is when Canada is not spared from the tariffs imposed on it, right? Because in your chart, you perfectly explained that Canada and Mexico are the two most sensitive countries in the world when it comes to US-China trade war. And if the US imposes significant tariffs on either Canada or Mexico, that would definitely be a big factor for the bears selling the Canadian dollar. And then you might get a level in the realms of 145. But again, this is not our base case as of yet.
Yeah, exactly. I think that would be the trigger to of such a move higher to those kind of levels. But as I mentioned as well, the dollar CAD exchange rate has been the least volatile out of the G10. So I think a 5 cent move higher anytime soon is highly unlikely. And realistically, other currencies are probably going to absorb this dollar strength more so than the Canadian dollar. Now, in the interest of time, I think we'll have to end the Q&A there. But just another big thank you to everyone for joining and to Boris as the speaker for today. And just a final few remarks from me before ending today's session. Firstly, whatever email address you use to register for the webinar, you should automatically receive the recording of today's session too. And secondly, just a reminder that it's not just currency volatility and risk management where we can help you out. Yeah, you can talk to us about our trade solutions, how we can help organizations accelerate payment speed or diversify into alternative markets. Or you might be interested to know about our automated global payment solutions, compliance controls, and fraud prevention measures. So do reach out to your point of contact at Convera about any of this, or if you have any questions related to today's material, today's presentation from myself and Boris, do reach out to our team. That's Ask Market Insights at convera.com. So thanks again, everyone, for joining us today. Wishing you all the best and good luck for the rest of the year and planning for a successful 2025.